Welcome to another edition of Business 7, the program where we dissect topical issues of the day. And of course, right now, there is only one word on the lips of Namibians, and that is COVID-19. We will be talking to Rowland Brown, renowned economist, director of Ceres Capital, and also with the Economic Association of Namibia, about the extent of the current situation in Namibia and what can be done to mitigate its impact. We're also taking a look at the impact of the virus on informal businesses like taxi drivers and vendors, in this case kapana sellers, and we're going to bring you video on that. We also have Miriam Ba in the studio. She's a tax expert from PwC in Namibia, also looking at the COVID virus and what businesses can do to mitigate this. Stay tuned. COVID-19, the one thing Namibians are talking about non-stop. To put things in perspective, we have Rowland Brown. He's the director of Ceres Capital and also part of the Economic Association of Namibia. Rowland, welcome and thank you for your time.
Thanks for having me.
Put this in context for us.
Yeah, so we released a report yesterday, basically looking beyond the immediate health kind of side of this shock that we see in the economy at the moment, or in the country at the moment. And the reason for this is that I think much attention is going to how we slow the spread of this and ensure that it doesn't become a major problem from a health perspective. And this is what much of the rest of the world is doing, and it seems that the countries that have been very proactive in doing this have handled the health side of this much better than others. But the big problem that we see at the moment is that the countries that have taken these pretty extreme measures like lockdowns have also introduced stimulus packages in order to try and ensure that the economic implications of those lockdowns are not too severe. Now in Namibia, we are moving towards the lockdown situation very quickly, but we haven't seen any of the economic stimulus. And the problem with this is that the economic fallout from this is going to be devastating. The reason that we say that is, and much of the pushback that we get against this position seems to be based in a complete misunderstanding of the position that we're taking, which is that many of the wealthy people in the country, many of the tertiary sector employees in the country can go and work from home. Many of the businesses that are focused in that sort of space can operate without their people being at the office. Not all of them. Tourism is a good example of one that cannot, but many of these industries can. However, your primary and your secondary industries are going to be devastated by this. The likes of the construction industry, if the employees in the construction industry cannot be at work, it's very difficult to see how the construction companies will be paid and how they'll be able to pay salaries. The same in many of the parts of the agricultural sector, the mining sector, the manufacturing sector, the wholesale and retail trade space, and similar. And the impact of this can basically end up being that many of the employed people in the country lose their jobs as a result of the health measures that are quite rightly being taken. But without that support from government and from that huge fiscal and monetary stimulus, we now sit in a situation where the second round effects from trying to protect on the health side can be just as bad as the health effects.
Rowland, yes. As you've said, we've seen massive stimulus packages coming internationally. What is Namibia's position? Are we in the space where we can help?
Yeah, so what we've seen in Namibia so far is that the then governor, the now Minister of Finance, announced these major interest rate cuts on Friday last week, so 100 basis points. As discussed in your paper, I think that puts just under $1 billion back into the pockets of households, $1 billion and businesses. $1 billion is about 0.5% of GDP. If you look at what's being done elsewhere in the world, countries like the US, the UK, Spain, many other parts of the world, the stimulus packages that you're talking about to deal with the effects of these lockdowns are 10+% of GDP. It looks like the US is going to announce a 10% fiscal stimulus, so $2 trillion additional spending by government, by the American government, and also an additional $4 trillion of spending by the central bank. And so that's 30% of US GDP that's being injected to try to deal with this. And even then, the expectation is that US GDP growth is going to drop by about 50%, or the US GDP is going to drop by about 50% in the next quarter, and unemployment is going to go from 4% to 30%.
Staggering numbers.
Yeah, it's absolutely crippling numbers. And the problem with this is that if you consider the follow-on from that, it's that now you have huge numbers of unemployed people, tax for government starts to disappear, government spending more money but has less revenue. You start to see production falling, you start to see exports falling, you start to see consumption falling, and you can get yourself into an extended economic black hole. That stimulus is it's something that much of the world is doing and much of the world needs to do, and we're not really seeing it here yet. The impression that we get is that the gravity of the situation and the urgency of the situation is not well understood. With the lockdown coming now in the next day or so, it seems as if many companies are going to start to retrench quite aggressively now already. The reason for this is that we basically have 7 active cases that we know of at the moment. Say we're out by a factor of 10, say we're out by a factor of 100. Say there's 700 cases, which there aren't, but let's assume it. If we close down the country every time there's 700 cases, with our population, we'll have a number of shutdowns through the year. And the implication of that is that productive activity in the country is going to fall off a cliff. Because of this, many companies are basically being proactive and saying, we cannot withstand that type of shock over the next year. And if there's no fiscal support, if there's not material monetary support, our business will not be standing 6 months from now, much less 18 months from now. And as a result of that, businesses are looking at how do we, sustain some employment rather than go under. Now, our argument around this has been completely misconstrued as, we are just sort of being heartless capitalists. That's not the case at all. Basically, the situation is that we have to take the health measures that we're taking. My personal view is that we're probably acting a bit early, and we're acting way too slowly when it comes to way too slowly and much too small when it comes to the fiscal and monetary response. Our monetary hands are tied to some extent by the currency peg, but at the same time, from a fiscal side, we're not reacting nearly fast enough. But of course, we've had a lot of changing of seats of late and a new finance minister and so on. So it will take a little bit of time, but we need to react big and we need to react quickly to ensure that we don't have a major crisis here. Now, the health things we have to do, but we cannot do them in isolation without trying to ensure that we don't have some of the fallout. The other thing that I think one needs to bear in mind is that there's this view that we have no money, and that's the reason that we're not taking dramatic steps. It's not the case. We have got emergency funds, and those emergency funds have been, in many instances, ring-fenced for specific purposes. But those specific purposes are potential emergencies in the future. So you don't sit with a child in hospital and say, oh no, we can't spend our emergency funds because there might be an emergency in the future. When the emergency is on your doorstep, you have to use those funds. So we have got quite substantial funds available that we can inject into certain things. We have to accept something else, which the world is accepting now, which is that the normal fiscal rules are off the table. We are not in a situation where you target 3 or 4% deficits. We will be forced into a situation where we have a 5 to 10% deficit, and we need to ensure that while we're borrowing aggressively, our GDP doesn't drop off a cliff, because we're going to have a situation where debt to GDP ratio, being a ratio of one versus the other, where debt is increasing and GDP is falling. And we need to protect that GDP as well. Now, the employment side of our economy, so household consumption is about 70% of our GDP. So if we do not protect households through this, we are going to have a situation where we find ourselves in a debt trap. So we need to act, we need to be very proactive, and we need to act swiftly on this. We've made a number of proposals with regards to where funds can be sourced from, And we are very cognizant of the fact that this will end at some point, and we don't want to be in another crisis of our own making in terms of how we've handled this. So our proposals are primarily looking at ways that government can fund this off balance sheet. There is some using up of some of the emergency reserves. There's some bridge financing. There's some support from the central bank, so very targeted quantitative easing from the Namibian side from our central bank, which is doable despite, I think, views to the contrary. And then also looking at how the commercial banks can be utilized to assist in basically bridging cash flow challenges. And I think a lot of our proposals lean on the central banks to actually administer some of these things because they are used to dealing with large numbers of people, large numbers of applications and so on. And I think that they are far better positioned than any other entities to actually administer some of these proposals that we put in place. I think the final kind of critical thing to mention here is that many people, I think, are looking at what we're saying and the quantum of our proposals and why we're making these proposals and thinking that it's a bit over the top. It isn't. And by the time people realize that the magnitude of the situation, it's going to be too late if we don't act quickly. So we have to act very quickly if we want to ensure that we don't have a much, much bigger economic shock than we need to have.
Coming back to your proposals, just elaborating a little bit on them, you have some very interesting proposals when it comes to job losses and cash support and, of course, the civil service.
Yeah. So the first, the primary basis on which our proposals are based is on protecting household incomes and ensuring that we don't have major layoffs. Now, the reason that household incomes are under threat is because companies are going to go under. And if companies go under, obviously they close their doors and they send people home. So we need to make sure that there's a degree of flexibility in employment for companies so that firstly, people don't just lose their jobs. And secondly, as we start to recover, salaries and wages and so on increase quickly again. So that's the primary basis on which our proposals are based. Then in terms of that, we believe that there needs to be some flexibility with regards to wage payments over the next few months. If people are sitting at home and not producing, and that's putting businesses under pressure, rather than the business go bankrupt and close its doors, firing or reducing 100% of its employment, we say rather try and find ways that you can keep everyone employed and adjust incomes lower during a period when people are not being productive. This is very, very tough on the people that we're talking about though. Because obviously they have expenses as well. And so we focused on how can we ensure that those expenses are carefully managed and reduced to the greatest degree possible. So there we have a proposal with regards to reducing rent or mortgage payments during periods where people's incomes are negatively affected. And we have details on how that can be funded. This is not a pie-in-the-sky idea. This is a practical idea that can be implemented, and we explain how it can be implemented. The reason for this is that the provision of a rental house, the provision of a mortgage is not free, so we need to find a way to ensure that the cost of providing that is not borne by an individual that can't afford to bear it, because then you're just causing more problems than you solve. So we have practical proposals there, as well as that we have practical proposals with regards to how utility payments can be basically put on ice. If you use water, you do still pay for it, but you have an extended period of time in which to do it. And then at the same time, you can't be charged interest on it. So we have on your non-payment. So we have measures that can ensure that the City of Windhoek and other utility providers can continue to provide those services without experiencing cash flow pressures that they can't handle, because obviously City of Windhoek has costs as well. So if it's not receiving any income, but it still has to pay its costs, their problems. So we've come up with practical solutions to that as well. We've looked at a number of tax proposals, particularly aimed at lower income people, so higher income people, those people working in the tertiary sector giving me a hard time on Twitter, who are not going to be affected by this too much. They don't get the benefits of this, but lower income people get tax breaks. At the same time, we have a specific proposal with regards to informal sector. So this includes the likes of domestic workers, but also people like taxi drivers and other informal sector employees. And we believe that there's not much that one can do that doesn't include a direct transfer from government. So we propose a direct transfer to registered informal sector employees effectively, and that also has the benefit of ensuring that people become registered. So whether you're registered now or not doesn't matter, but you have an incentive to go and register as an informal sector employee with the Social Security Commission, and then direct transfers from the state will be required. That's the most expensive of all of our proposals, is to provide some support to informal sector people temporarily while this goes on. And then yes, we've looked at all of these things. We've looked at how they can be funded. We've looked at manners in which that funding can not put undue pressure on the already strained government finances. So government finances are strained going into this, but I mean, obviously SACU payments, the taxes on trade will be under huge pressure. Mining profits will be under pressure. Personal income tax is going to come off a cliff. Company tax is going to disappear this year, or largely disappear this year. And so government finances are under major pressure, and we just have to accept the fact that this is not going to be a normal fiscal year. We need to get through it as best we can. We need to ensure that we don't have growth falling off a cliff, and that we're well positioned for a recovery after this virus has passed. And obviously this is all due to the fact that we need to take these severe precautions when it comes to people's health.
Well, it's a relief to see that there are some measures that can be taken to assure that Namibia survives this the best it can, especially in light of very, very little information coming from government in terms of how we're going to handle this fiscally. Rowland, thank you very much for your time.
Thank you for having me.